The point about the credit bubble is that this is the largest credit bubble in history. And the easiest way to understand that, I mean, most people don't understand that we are in a credit bubble. But if you tell them that we're in a debt bubble, now that makes sense.
Right.
But credit is the other side of debt. Credit equals debt, always, always. It's two sides of a balance sheet. So if you've got maximum debt, then obviously you've got maximum credit around. And what the Austrian economists call the business cycle, in fact, is actually driven by bank credit. And it's when banks not so much destroy credit, because it's the only way credit can be destroyed is basically through defaults, if you like. What they will tend to do is they'll tend to move their lending away from the private sector to safety. And the regulators say that the safest place to lend, of course, is short-term to your government, which is why the government is selling so many T-bills, is particularly growing evidence that the global economy is slowing. The US economy is slowing. I mean, I think it was Atlanta Fed produced some quite alarming figures the other day, it was last week, suggesting that, in the last quarter or the fourth quarter or whatever, things have actually slowed very, very sharply. And we're now in a recession. And if we have another quarter like that, it's going to be a technical recession or an official recession. But I mean, they're only saying half the story, Danny, because if you take the budget deficit, which is roughly 6.5% of GDP, out of GDP, you're then left with the private sector. And on the Congressional Budget Office's own figures, total GDP, they expect in this current year to be growing at 4.5%. So on their figures, the private sector is already contracting by 2%. And that's in nominal terms. And then if you put in inflation adjusted or just CPI adjusted, let's not use any sort of fancy numbers, just the official numbers, then quite clearly it's contracting at the rate of about 5%. Now that, by any definition, is sort of verging on a slump. So that is the background to it. And I think investors are beginning to get sort of concerned that this indeed is the case. I mean, they've ignored it so far. They've ignored it because of greed. I mean, you got all this credit,
right.
$1 trillion of leverage in the US stock market. And the bulk of that, I guess, we don't know for certain, but the bulk of that, I guess, was sort of chasing fancy tech stock. So, this bubble, when it bursts, I think could be rather nasty. And the other point I would make about it is that not only do we have a mega credit bubble bursting, we also have Smoot-Hawley Mark II tariffs being brought in by Trump. And already you see, the new prime minister in Canada saying, we're going to hit back with our own tariffs and all the rest of it. We've got exactly the same combination, but this time it's actually a lot more violent. This is not good. So I am extremely pessimistic on the outlook for stock. I think that they will fall so much that stocks' value as collateral will start, if you like, upsetting the banking system. We already have a commercial real estate disaster in America. I also think that, obviously the Fed is going to do what it can to try and rescue this situation. But the extent to which it does it is going to undermine the dollar. So what are the foreigners going to do? The foreigners are going to say, we don't want our dollars anymore. It's quite simple. Now, their own currencies, I have to say, are in a similarly powerless condition. So what do they do? The only thing they do is just get out of credit and get into real money, which is gold. And so a brief summary of the current situation as I see it.
The largest credit bubble in history is nearing its breaking point. While the first part of this discussion examined the unsustainable nature of this debt-driven financial system, the second part will delve into the broader consequences of its collapse, the role of gold and silver in mitigating risk, and how investors should position themselves for what's coming. The unraveling of this bubble will not be a slow, orderly process. It will be fast, chaotic, and unpredictable. When credit markets seize up, the world will wake up to the reality that paper assets can be printed, but real wealth, gold and silver, cannot be manufactured out of thin air. The most dangerous aspect of the current financial system is the sheer size of the global debt load. Governments, corporations, and households have been borrowing at an unprecedented pace, assuming that economic growth will always outpace the cost of their liabilities. However, when interest rates rise, the entire system begins to break down. Debt that was once manageable at ultra-low interest rates suddenly becomes impossible to service. This is what we are now witnessing. In the United States, the federal deficit is ballooning while economic growth is slowing. Even official figures indicate that GDP growth is becoming increasingly dependent on government spending rather than private sector expansion. Adjusted for inflation, the real economy is already in decline, and most people don't realize it. If government spending were removed from GDP calculations, private sector growth would be revealed as negative. One of the most overlooked trends in today's financial system is the rapid decline of foreign demand for U.S. assets. In the past, the United States was able to run massive deficits because foreign nations were willing to finance them by purchasing U.S. Treasury bonds. This is no longer the case. China, once the largest foreign holder of U.S. debt, has been steadily reducing its exposure. Russia has already dumped nearly all of its U.S. Treasury holdings. Even traditional allies such as Japan and European nations are scaling back their purchases. Instead of accumulating dollar-based assets, these nations are increasing their gold reserves. Why is this happening? Because the rest of the world understands what's coming. As the debt bubble bursts, the Federal Reserve will be forced to intervene in the markets, injecting liquidity and monetizing debt. This will further devalue the dollar, eroding its status as the world's reserve currency. The problem is that fiat currencies across the world are all in a similarly weak position. The euro is experiencing its own crisis, Japan's yen is weakening under the weight of its massive debt load, and even China's currency is losing credibility. This means that the global financial system is desperate for a stable asset to anchor itself to. That asset is gold. Gold has always been the ultimate safe haven asset during times of economic crisis. However, this time is different. Unlike past financial collapses, where gold was merely a hedge against uncertainty, the next crisis will likely see gold re-emerge as the foundation of a new monetary system. Central banks understand this. That's why they have been accumulating record amounts of gold over the past decade. While Western central banks have publicly dismissed gold as an outdated relic, their actions tell a different story. The next phase of the financial crisis may involve a formal revaluation of gold. Governments could attempt to stabilize their economies by backing their currencies with gold, forcing an official price adjustment to reflect its true value. This could send gold prices soaring to levels that are unthinkable today. Analysts speculate that in order to properly back global currencies with gold, it would need to be valued at $10,000 per ounce or higher. As the world heads toward an inevitable financial reset, investors need to take action before the crisis fully unfolds. The biggest mistake people make during times of economic turmoil is waiting too long to act. Once a currency crisis begins, it is nearly impossible to secure gold and silver at reasonable prices. Physical ownership is key. While ETFs and gold-backed funds provide exposure to gold and silver prices, they do not provide direct ownership of the metal. The risks of counterparty failures are high in a crisis, meaning that investors who rely on paper claims may find themselves unable to access their metal when they need it most. The best strategy is to own physical bullion stored in secure, accessible locations. Diversifying storage across multiple jurisdictions can provide additional protection against government intervention or capital controls.
The first thing I would say is it's not gold and silver going up so much. I mean, there is an element of that. You can't disentangle it, but it's basically paper currencies going down. This is actually what the central banks see. The reason that central banks are buying gold is that they're actually selling fiat. And, that is a very important point to understand. Ultimately, when everybody understands that it's fiat going down and not prices rising, and we're not just talking gold at this stage, but we're also talking about, groceries and everything else, then the currency's doomed. So we are on the beginning of that curve, in fact, we were on the beginning of that from 1971, when we started in 71 with $35 an ounce, and we're now close to 3,000. But obviously, the way people think, they're not thinking like, so they're trading it as if it was a stock or, whatever. I would personally think that 3,000, there could be some consolidation around about that 3,000 level. It's a view. I wouldn't sell on the basis that it's going to, it's going to consolidate and it might tip back and you might be able to do this, that, and the other. Why? Because if I sell gold, I'm buying dollars. I don't want to buy dollars. For goodness sake, I want to get the hell out of them. And as far as silver is concerned, I think with the gold-silver ratio close to 90, that to my mind is far, far too high. Silver does have a monetary role. There is absolutely nothing in the price for a monetary role at the moment. But I think when you get the collapse of currencies, silver has got two advantages. Firstly, it's, somebody said it's the poor man's gold. I think that's actually, a sort of a reasonable description for the role of silver in terms of being useful for smaller transactions. If you think that the politicians might try and ban ownership of gold, and politicians are stupid, let's face it, when it comes to economics, they are on a completely different agenda. But then you ask the question, okay, if they ban ownership of gold, are they likely to do so with silver? And I think the answer is no, because it's not regarded as a monetary metal anymore.
The largest credit bubble in history is nearing its breaking point. While the first part of this discussion examined the unsustainable nature of this debt-driven financial system, the broader consequences of its collapse are even more alarming. As this bubble deflates, the world will witness a rapid, chaotic, and unpredictable financial unraveling. When credit markets seize up and liquidity disappears, investors will be forced to confront the reality that paper assets can be printed, but real wealth, gold and silver, cannot be manufactured out of thin air. The current economic system is built upon an illusion of infinite debt creation. But when confidence erodes, the entire house of cards will fall. The most dangerous aspect of the modern financial structure is the sheer size of global debt. Governments, corporations, and households have borrowed at an unprecedented pace under the assumption that economic growth will always outpace the cost of their liabilities. However, when interest rates rise and economic activity slows, this assumption collapses. Debt that was once manageable under ultra-low interest rates becomes unpayable, creating systemic risk that spreads through financial markets. The United States is a prime example of this dilemma, with its federal deficit soaring while economic growth stagnates. The illusion of prosperity is maintained only through massive government spending, masking the reality that the private sector is already in decline. When adjusted for inflation, real economic growth in the U.S. is negative. The only reason GDP figures remain positive is due to excessive government borrowing and stimulus spending. If this artificial boost were removed, the economy would be revealed as contracting at a concerning pace. This sets off a vicious cycle. Larger deficits require more borrowing, which necessitates more money printing, leading to currency devaluation and rising inflation. As inflation rises, central banks are forced to increase interest rates, making debt even more unsustainable. This loop of monetary destruction is precisely what has historically preceded major economic collapses and currency resets. One of the biggest warning signs of a collapsing credit bubble is the waning demand for U.S. assets among foreign investors. For decades, the United States has been able to run enormous deficits without immediate consequences because foreign governments, banks, and institutions were willing to buy U.S. Treasury bonds to finance these deficits. However, that era is rapidly ending. The world has begun the process of de-dollarization, where countries seek alternatives to the U.S. dollar in trade and financial reserves. China and Russia have dramatically reduced their U.S. Treasury holdings over the past few years, instead stockpiling gold at record rates. Even traditional U.S. allies, such as Japan and certain European nations, have started diversifying away from dollar-denominated assets. Central banks in emerging markets, particularly in Asia and the Middle East, have been buying gold at an unprecedented pace, signaling their preparation for a shift away from the Western-controlled financial system. The global move toward gold-backed trade agreements is already underway. Russia and China have signed bilateral agreements to conduct trade in local currencies, bypassing the dollar. The BRICS nations, Brazil, Russia, India, China, and South Africa, are actively exploring the creation of a gold-backed trade settlement system, which would sidestep reliance on the SWIFT banking network and U.S. financial infrastructure. These developments suggest that gold, rather than the U.S. dollar, is becoming the future foundation of international trade. Gold has always been the ultimate safe haven asset during financial crises, but this time, its role will be even more significant. Unlike past recessions, where gold simply acted as a hedge, the next financial collapse may trigger an official revaluation of gold as governments attempt to stabilize collapsing currencies. Many analysts believe that a return to some form of gold-backed monetary system is inevitable, particularly as confidence in fiat money continues to erode. In such a scenario, the price of gold would have to be revalued dramatically higher to properly back global currencies. Estimates suggest that for gold to effectively support monetary systems, it would need to be valued at $10,000 per ounce or more. While gold will play a critical role in the next financial reset, silver remains the most undervalued asset in today's financial system. Unlike gold, which is primarily used for monetary and investment purposes, silver has a dual function. It is both a financial asset and a critical industrial metal. The demand for silver is surging, particularly due to its use in renewable energy, electric vehicles, and advanced electronics. The photovoltaic solar industry alone is consuming silver at an unprecedented rate, and projections suggest that by 2030, silver demand for solar technology could surpass 30% of total global production. At the same time, silver mining production has struggled to keep up. Unlike gold, which is mostly retained and recycled, silver is often consumed in industrial applications, leading to potential supply shortages. The gold-to-silver ratio, which has historically averaged around 50-1, is currently above 80-1, indicating that silver is massively undervalued relative to gold. If this ratio were to normalize, silver would experience price increases that far exceed those of gold, making it one of the most explosive investment opportunities in the coming years. As the world transitions toward a post-dollar financial system, investors must be proactive in securing their wealth. The worst mistake one can make in times of economic turmoil is waiting too long to act. By the time a currency crisis fully unfolds, the availability of physical gold and silver will be severely limited. History has shown that during financial panics, gold and silver prices surge as demand skyrockets, often making it nearly impossible to obtain them at reasonable prices. Physical ownership is the only way to guarantee wealth protection in a financial crisis. While ETFs and gold-backed funds may provide paper exposure to gold and silver, they do not offer direct ownership of the metal. The risk of counterparty defaults is high in times of economic distress, meaning that investors relying on paper claims may find themselves unable to access their metal when they need it most. Secure, accessible storage of physical bullion is the only way to ensure true financial independence when fiat money collapses. The global financial system is on an unsustainable trajectory. The largest credit bubble in history is unraveling, and its collapse will trigger a financial transformation unlike anything seen before. As central banks and governments struggle to preserve the illusion of stability, their only tool will be monetary debasement through excessive money printing. This will result in a dramatic decline in fiat currency purchasing power, forcing individuals and institutions to seek refuge in real assets. Gold and silver are not just hedges against inflation, they are the foundation of real wealth in a collapsing monetary system. When the dust settles, those who own these assets will emerge on the other side of the crisis in a position of strength, while those who remain dependent on the fiat system will face severe financial losses. The time to prepare is now, before the coming crisis becomes impossible to ignore. The window of opportunity to secure physical gold and silver at today's prices is rapidly closing, and those who take action now will be among the few who truly understand what is coming. The future belongs to real money, and that means gold and silver.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.